The U.S. Jobs Report is a monthly snapshot of the American economy. It provides crucial data on employment, unemployment, and wages. Released by the Bureau of Labor Statistics, this report is eagerly anticipated by investors, policymakers, and businesses alike. Its significance lies in its ability to signal shifts in economic activity. The report's influence extends far beyond Wall Street. A strong jobs report can boost consumer confidence and fuel economic growth. Conversely, a weak report can spark uncertainty and market downturns. Understanding the key components of the jobs report is crucial for anyone seeking to navigate the complexities of the U.S. economy. The report's headline numbers, such as the unemployment rate and non-farm payroll additions, often dominate headlines. These figures offer a glimpse into the overall health of the labor market. However, a deeper dive into the report reveals a wealth of information. By analyzing industry-specific data, wage growth trends, and labor force participation rates, we gain a more nuanced understanding of the economic landscape. Investors and policymakers rely on this data to make informed decisions. Businesses use the report to guide hiring strategies and investment plans. As we approach the release of the February 2025 jobs report, economists and analysts are closely watching for signs of continued growth or potential slowdown. The current economic climate is marked by both opportunities and challenges. Inflation remains a concern, although it has shown signs of easing in recent months. The Federal Reserve's interest rate hikes, aimed at curbing inflation, have had a ripple effect on borrowing costs. Despite these headwinds, the labor market has remained remarkably resilient. Unemployment is near historic lows, and job openings continue to outnumber available workers. This suggests that the demand for labor remains strong, even as economic growth moderates. Economists are predicting modest job growth for February, with estimates ranging from 150,000 to 200,000 new jobs added. Wage growth is expected to remain steady, potentially exceeding inflation for another month. A positive jobs report, exceeding expectations, could bolster confidence in the economy's ability to achieve a soft landing. However, a weaker than expected report could heighten fears of a recession. Investors will be paying close attention to the details of the report, looking for clues about the future direction of the economy. The U.S. economy is currently grappling with a confluence of challenges. Inflation, while showing signs of cooling, remains stubbornly high, eroding consumer purchasing power. The Federal Reserve's aggressive interest rate hikes intended to combat inflation have increased borrowing costs for businesses and consumers alike. Consumer spending, a key driver of economic growth, has slowed in recent months. Rising interest rates and persistent inflation have made consumers more cautious about their spending habits. This slowdown in spending is being felt across various sectors. Adding to the economic uncertainty, several major companies have announced layoffs in recent weeks. These layoffs, particularly in the technology and finance sectors, have raised concerns about a potential ripple effect throughout the broader economy. The February jobs report will provide valuable insights into the extent to which these layoffs are impacting the overall labor market. The Federal Reserve faces a delicate balancing act as it attempts to tame inflation without triggering a recession. The Fed's primary tool for influencing the economy is its ability to set interest rates. By raising interest rates, the Fed aims to cool economic activity and bring inflation under control. However, raising rates too aggressively can stifle economic growth and potentially lead to job losses. The Federal Reserve closely monitors labor market data, including the jobs report, to gauge the overall health of the economy. A strong labor market, characterized by low unemployment and robust job growth, gives the Fed more leeway to raise interest rates. Conversely, a weakening labor market could prompt the Fed to slow or pause its rate hikes. The February jobs report will be a crucial data point for the Fed as it considers its next move on interest rates. A strong report indicating continued labor market strength could embolden the Fed to continue raising rates. However, a weak report suggesting a softening labor market could give the Fed pause. The Fed's decisions on interest rates have significant implications for investors, businesses, and consumers alike. Higher interest rates make it more expensive to borrow money, potentially slowing investment and economic growth. Section 5. Policy shifts and trade tensions. Impacts on the job landscape. Government policies and global trade dynamics can have a profound impact on the job market. Changes in tax policy, Trade agreements and regulations can create both opportunities and challenges for businesses and workers. For example, tax cuts can stimulate economic activity and lead to job creation, but they can also exacerbate income inequality if not carefully designed. Trade agreements, such as the United States-Mexico-Canada Agreement, or USMCA, can impact the flow of goods and services across borders, potentially affecting employment in certain industries. Trade tensions and tariffs can disrupt supply chains, raise costs for businesses, and lead to job losses in sectors exposed to global competition. In recent years, there has been a resurgence of protectionist sentiment in some quarters, leading to calls for tariffs and other measures to protect domestic industries from foreign competition. While such measures may provide short-term relief for some workers, they can also lead to higher prices for consumers, retaliation from trading partners, and ultimately harm the overall economy. Investors and businesses need to stay informed about policy changes and trade developments that could impact the job market and their investments. Section 6. Riding the wave investment strategies amidst market volatility. The jobs report often injects volatility into the financial markets. A strong report can send stock prices soaring. Conversely, a weak report can trigger a sell-off. Investors need to approach the jobs report with a balanced perspective. Don't overreact to a single data point. The jobs report is just one piece of a larger economic puzzle. Instead of making impulsive trades based solely on the report's headline numbers, consider the long-term implications for the economy and your investment portfolio. Diversification is key to managing risk in volatile markets. Avoid putting all your eggs in one basket. Instead, spread your investments across different asset classes such as stocks, bonds, and real estate. This can help cushion your portfolio from sharp swings in any one sector. Consider defensive sectors. Some industries, such as healthcare and consumer staples, tend to be less sensitive to economic downturns. Investing in these defensive sectors can provide stability to your portfolio during periods of market volatility. Section 7. Data-driven decisions, leveraging the jobs report for investment success. The jobs report is a treasure trove of information for investors who know how to decipher its complexities. By delving deeper into the report's data, investors can gain valuable insights into the health of specific industries, wage growth trends, and the overall direction of the economy. Pay attention to industry-specific data. The jobs report provides a breakdown of job growth, or losses, by industry. This information can be particularly valuable for investors looking to make targeted bets on sectors poised for growth. For example, if the report shows strong job gains in the technology sector, investors might consider increasing their exposure to tech stocks. Analyze wage growth trends. Rising wages are generally a positive sign for the economy, as they indicate that consumers have more disposable income. However, if wage growth outpaces productivity gains, it can lead to inflation. Investors should monitor wage growth trends closely. Understand the relationship between the jobs report and other economic indicators. The jobs report should not be viewed in isolation. It's essential to consider the report in conjunction with other economic data, such as GDP growth, inflation, and consumer spending. Section 8. The human element beyond the numbers. While the jobs report is often viewed through the lens of economic data and market implications, it's crucial to remember the human element at the heart of these statistics. Each data point represents an individual, a family, and a community impacted by the ebb and flow of the labor market. A strong jobs report signifies more than just economic growth. It represents opportunities for individuals to find meaningful employment, support their families, and achieve financial security. Conversely, a weak report can reflect the struggles faced by those who are unemployed or underemployed, highlighting the importance of policies and initiatives that promote job creation and economic opportunity for all. As we analyze the data and assess the implications of the jobs report, let us not forget the human stories woven into the fabric of these numbers. Section 9. Shaping the future, a collective effort for a vibrant job market. The future of the U.S. job market is not predetermined. It's shaped by technological advancements, globalization, demographic shifts, and policy decisions. Creating a resilient job market requires a collective effort from policymakers, businesses, educators, and individuals. Investing in education and skills training is paramount. Workers need to adapt and acquire new skills to remain competitive. Policymakers can expand access to affordable education and training programs. Fostering innovation and entrepreneurship drives job creation. Supporting startups and innovation leads to new industries and employment opportunities. Addressing income inequality ensures a sustainable and equitable economy. When more people participate in economic growth, it benefits everyone. Policies promoting fair wages, affordable healthcare, and access to opportunity reduce inequality. Together, we can shape a future where the U.S. job market provides opportunities for all.